Please note that the information on Retire Vivid referenced in this video is accurate as of September 6th, 2024. Changes to laws and regulations may make portions of this segment outdated and no longer relevant. The information presented is for educational purposes only and is not intended to provide investment, tax, or legal advice. Please see our full disclosure at the end of this video.
Welcome to Retire Vivid. I'm Karen McCarty. That's Tommy Breitbach. And today's episode is on tax planning. Tax planning when it comes to your IRAs, your 401ks, your brokerage accounts. I mean, we're going to get in as much as we possibly can today, Tommy. But this is a good one today.
You know, it can sometimes be a forgotten piece of the puzzle, but it's very important. It's a real savings in retirement and something that, you know, maybe we don't see enough of.
Right, because, you know, a lot of our clients, what they always say to us is, Cam, you know, I don't mind paying taxes. I just don't want to pay any more than I have to.
Yeah, it's very important, you know, probably somewhere between working to retirement to later in life, you're going to find a period where taxes are on sale. And so it's really important to evaluate when that is for you.
You know, I'm glad you mentioned that because I think with a lot of people, I mean, especially as we're nearing retirement, we were all taught, or they were all taught something different, right? Meaning that, you know, while you're in these higher tax tiers, while you're in the workforce, you're supposed to be in this higher tax bracket, which makes sense because you have W-2 income coming in, you name it. But then we're all taught, okay, once you retire, you're going to drop into a lower tax bracket. Well, that's true, but what if you are a pretty good saver?
At some point, you're going to have a required minimum distribution, you know, and we've touched on this in other episodes, but the Roth is relatively new, so people may not be familiar with it, kind of how to use it, how to get money into it, and it, you know, we're going to provide a little information on that today.
Well, I think a lot of people, you know, that's what they say to us. They say, well, I should have met you 10 years ago, because a lot of, I mean, if you look at our generation, I mean, we are pumping money into that Roth because it's the value of tax-free money. But for people that have been feeding those 401ks, right, they got those tax deductions going in, right? It helped them tax-wise. But on the flip side, they got to pay ordinary income tax. And so, Tommy, what I want to do is I want to set the stage. Because again, you know, in terms of why is tax planning such a big deal, I want to talk about the federal law, and then I want to move to the state of Iowa here at home. And then we're going to move through some examples throughout our episode today.
Right, so the first one being, you know, the longer period of planning opportunity was the required minimum distribution age. So, you've put money in pre-tax to that pre-tax 401k, the traditional IRA. At some point, you have to take money out of that, pay taxes on it because you've never paid taxes so far. So in 2019, effective 2020, they passed the original Secure Act. Prior to that, RMDs started at age 70 and a half. The first Secure Act moved RMDs to age 72.
From 70 and a half.
From 70 and a half.
So that, okay, yep.
Yep, and then they followed on with Secure Act 2.0 and moved it to 73. And then for those individuals turning or not turning 73 until 2033, that goes out to 75.
Okay, there's reasons why we're talking about this, especially when it comes to planning, because we just talked about a Roth a little earlier. But also, let's talk about this too, because for people that, in terms of the stretch IRA, for people that inherit it, you're no longer able to do a stretch IRA. You have to deplete that over 10 years now.
There's a couple exceptions, spouse and somebody who's not more than 10 years younger.
Sure.
But if we're looking at maybe kids inheriting your IRA, those individuals will have to deplete that account in 10 years. So you used to be able to take, a percentage of that account every year, stretch it throughout your lifetime, but now that account is depleted in 10 years.
Well, I guess when it was fun, it was fun. So, they had changed the game, but it is what it is. So, okay, but there's reasons why the Secure Act plays such a big role when it comes to tax planning, because of the changes to retirement, changes to the IRA. Okay, let's move on to reason number 2 why tax planning is such a big deal, and this is the Tax Cuts and Jobs Act. This is going to sunset pretty darn quick.
In 2017, your marginal tax rates were higher, your standard deduction was lower. Right now, we're in a period of the lower marginal rates. We have the 10, 12, 22, 24, and from there. And the standard deduction, they doubled it from prior levels.
Basically doubled it.
Basically doubled it. And that is set to sunset in tax year 2026. So reverting back to those higher levels, the 10, 15, 25, 28, possibly cutting that standard deduction in half. So you're in a window of federal tax law right now where marginal rates are low, standard deduction is high.
Right, basically taxes potentially on sale. And then the last one here in the state of Iowa, we got House File 2317, specifically the retirement income exclusion. Pretty big deal for retirees.
Right, it's a benefit for Iowans 55 and older, disabled, or a spouse that has an insured interest in somebody else who qualifies. And that has removed a lot of retirement income, or I guess has removed tax liability on retirement income from IRAs, qualified annuities, pensions, a bunch of big pieces that people use in retirement.
Right, because one of the things that we're big fans of are Roth conversions, right? Meaning, so with a Roth conversion, this is where you have a traditional IRA, and then you convert to a Roth. The kicker is, though, that could potentially generate a taxable event. The question is how do you do it, and how much do you put into it? And that's why tax planning is such a big deal.
Right, it's, while you're working, you're typically in a higher income level. You have most of the time a window where maybe you don't have the same income need. You get a preference on Social Security, but then you're still looking at the required minimum distributions down the road.
That's right. We're going to talk more about that here in just a minute. We're going to talk about why this plays a role when it comes to planning. Make sure you stay with us. We got a lot more right after the break.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Welcome back. If there's one thing that you're seeing from us is how do we save money in taxes during retirement? But it's not just on the IRAs, the 401ks. It's across the full spectrum when it comes to helping people save money in taxes and when are they on sale, which is a weird way of looking at tax planning.
Right, and we're big proponents of tax planning because if you are looking at those traditional 401ks, the traditional IRAs, we've mentioned RMDs, you're going to have to take a distribution out of those at some point, and you pay that's 100% reportable as taxes. So do you find out when your opportunities are to pay taxes at the lowest rate, or are you sitting there just waiting for the distribution to happen?
And a lot of times that's what we see people, because they go, when we talk about when are they on sale for you, people go, oh, well, yeah, that sounds great until it comes down to the planning to start paying taxes. Because again, a lot of our clients, Tommy, they don't mind paying taxes. They just don't want to pay any more than they have to. But if you take a look at where this, in terms of where our biggest assets are, it's usually the home and it's those traditional IRAs, 401ks. And again, if you take a look at what an IRA means, this is kind of fun. We all know an IRA, in terms of what it's called, an individual retirement
account,
right? That's what we all know it as. But under the tax code, that's not what it is. Under Title 26, Section IRA, it's actually called an individual retirement arrangement. Who's the arrangement with, I wonder?
Let them think about that.
We'll let our viewers figure that one out. But again, it's an arrangement, right? You got a tax benefit going in, and on the flip side, you got to pay tax on it. That's just the way it works. But there's no way out of it, meaning that when you turn those ages, you talked about this, you got to take an RMD, and that's usually where this tax bomb, if you would, gets triggered, right? It gets triggered. So Tommy, real quick here, let's talk a little bit about this in terms of, okay, all this talk of winter taxes on sale. Let's take a look. So here we got a couple, and if you can see here, we got the marginal tax rates. We got the 10, the 12, the 22, 24. So here we got a married couple. They're both working, and as you can see, they're in the 22% tax bracket. But then you fast forward, and the wife retires, and you can see we got the husband still working, because what do we all need?
Health insurance.
We all need health insurance, because what age is Medicare?
65.
65. That's a whole other episode that we did. But the wife took her benefit, her Social Security, early. Fine, she knew about the reduction, all good. Then we fast forward to age 66. The husband took his Social Security, they don't have pensions, and they're both pulling from a traditional IRA. But notice something though, Tommy. They dropped from the 22% down to the 12. But then we fast forward. This is the stuff we're talking about. The required minimum distribution. This couple was a good saver, which then pushed them back up into those higher tax tiers. So when were taxes on sale? That's the stuff we're looking for.
Yeah, and this is why we're such a big proponent of tax planning and finding out when taxes are on sale for you, because when that RMD hits, in the example you gave us, you lost that opportunity in the 12% bracket.
Absolutely, and that was the opportunity, right? I mean, just fill up the bracket. We call it bracket bumping. So again, we don't want to cross into the next tier, because I don't want to go from the 12 to the 22, for example. I just fill that bucket up. Now here's the kicker. This RMD that people have to take, you can't convert it. I mean, it's done, meaning that you have to either you spend it, you gift it, which you could do, which is a whole nother episode, or you reinvest it, but you cannot take the RMD and put it into a Roth. That's why we try to catch people prior to this age.
You mentioned it. Once you're at that age, it's tax planning it's not as advantageous.
You know what? Let's dive a little bit more into this. So we got a few more examples here. So let's talk about people that got different income needs, they got different asset levels, and how tax planning plays a role. Tommy, let's start with somebody that's got $80,000 of an income need, they got Social Security and some retirement assets.
Right, so $80,000 income need, they have $60,000 combined Social Security coming in, IRA 401k balances combined at $600,000, growing 5% a year. So to get to that $80,000 income need, there's a $20,000 distribution. Well, here's an RMD schedule. At 73, they're going to have to take out, a little over $23,000, pretty close to income need. At 80, they're taking out almost $33,000, still within range of their income need. 85, that's gone up to a little over $40,000. Mm-hmm. So you can see in this example, if you're, the traditional 401k, IRA, if that RMD amount is kind of in line with your income needs, then you're okay. You may not need to look at the Roth conversions, but as numbers get bigger, that's where you review Roth conversion opportunity.
Well, you see, exactly right. This is the stuff we want to see because, again, in terms of what we do, math doesn't lie. It doesn't lie. And so this is a great example. Now, let's change it up. Let's say we got a couple that needs $100,000, and again, they got Social Security, and they also got some retirement assets there as well.
Right, and so individuals still have that same $60,000 Social Security, need $100,000 of income, so you supplement with $40,000 from their IRAs.
Right.
These individuals are 70, taking $40,000 out of a combined IRA balance of $1.5 million. You can see they're going along for a couple years. $40,000 is what they need. Hit 73, that first RMD is $60,000. You know, it's basically 1.5 times their income need.
Mm-hmm.
You go out another few years, 80, they're forced to take out $83,000.
Look at that.
85, that number goes up to, you know, almost $103,000. And typically this coincides with people, you know, you got the go-go, the slow-go, the no-go.
Yep.
You hit that age where you're not spending the money, but you're still forced to take it.
Yeah, what a great problem to have. What a great problem to have. But what's the problem here? It's a good problem to have, like I said, but I mean, that's additional tax that we got to pay. So this is the stuff we're looking for, folks. I mean, you know, try to take a look at the future in terms of what your potential RMD, your required minimum distribution would be, and find out when is that window in terms of when things are on sale for you. This is the stuff that we're trying to find. Because again, let's say we fast forward and this couple is 73, 80, you name it, and they're taking out this RMD. They cannot put that into a Roth, period. That's why we try to catch people prior to this age. Yet again, shown reasons why.
Right, and you know, subject to any tax law changes on Roths, but if, you know, where you're sitting at right now, looking to where you may be going, you can pay your known tax rate. You know what you're doing right now, you don't know what the future holds necessarily.
And Tommy, I think this is also why people really enjoy this, our 15-minute retirement review. This is where people have an opportunity to talk to us. I mean, what we're doing during this show is just doing a blanket across the board, just to give people some nuggets and some things to think about within their own situation. But what about, you know, if they have questions on taxes or Social Security, retirement in general?
Right, and it's, you know, we can answer those easy questions, and you know, everybody's situation is unique, but we've seen enough of them that, you know, most of the time, you know, somebody has gone that route, and we can provide some good information on that.
Absolutely. So we do encourage you all to take advantage of that 15-minute retirement review. Next, we're going to be moving on to some even more examples of why tax planning is such a big deal. Make sure you stay with us right after the break. Okay, so we just talked about a number of different items when it comes to tax planning, but what if we have different tax buckets, right? Meaning we have Social Security, we have a brokerage account, we have a traditional IRA. How does this all play a role? Because again, everybody has different income needs when it comes to retirement. The question is, Tommy, is which lever do you pull to get there? Meaning, do you pull, okay, your Social Security is coming in as an income. Do you then pull the rest from an IRA? Do you do it in proportion? What makes sense for you?
We have spent time on the, you know, your traditional IRA, your pre-tax assets, but there's a lot of ways to be tax efficient. Social Security, you get a wonderful tax preference on your benefit. You have the option in those brokerage or non-qualified accounts. You have ordinary income versus, qualified dividends or long-term capital gains, a lot of different ways to get to your income needs.
Because again, everything's taxed differently, and we kind of break it up from that 1099 now money, meaning that's your capital gains, your dividends, you name it, where it's like windshield wiper, right? You make money, you pay taxes, you make money, you pay taxes. The next one's the 1099 later money. That's the IRA. We've already talked quite a bit on that. It's taxed later, 100% ordinary income. We got 1099 never money, which is the Roth. But again, it just comes down to, Tommy, do you do it in proportion, or do you, in terms of that income need or those big ticket items? I mean, how do you plan around all of these different buckets?
If we're looking at different sources of income, we have an example here of how to get, how to use those different buckets. Does it make sense to take all of your non-qualified assets and then your traditional or pre-tax assets and then your Roth, or do you take them proportionally? So this individual here, $60,000 income need, has $25,000 of Social Security benefits, and he's looking, do I go 1, 2, 3 down the line, or do I take a little bit from each of the counts?
Right.
So you can see in the instance where he takes all of his non-qualified assets and then his pre-tax assets and then his Roth assets, you see a tax bump in the middle. He's going to estimate it owed, almost $58,000 in taxes.
Okay. Yep.
So if he does them proportionally and bridges a little bit, so you're using the, tax preference on
Social Security,
the non-qualified account, and the Roth in proportion with the pre-tax assets, you can say he pays a little bit of taxes each year, but across that, 23, 24-year span, he owes about $35,000 in taxes.
Versus almost $58,000.
It's a substantial saving. So it's very important to evaluate, where you're at and how can I be tax smart about it.
How can you be tax smart? That's exactly right. This is the stuff we're looking for. I mean, because again, how do you save money in taxes? This is one way to look at it. So when people are working with a planner, it's important that you look at all those different buckets to accomplish that income need, but tie it with a bow in terms of how do you save money in taxes along the way. So that's good stuff. Let's keep moving. We got some other good things. You just mentioned Social Security in terms of that Social Security, you get a tax preference with it. Let's talk about that and show an example of how powerful Social Security can be from a tax perspective.
And so, Social Security goes through the provisional income formula to determine how much of it is taxable. So it's not that it's the same dollar for dollar as you have with an IRA distribution or wages while you're working.
Yep.
It goes through its own formula. So in this example, we have two individuals, we'll say 67, 65, married filing jointly, have $60,000 in Social Security benefits, and that's all they need for income needs.
Okay.
They pay zero taxes.
Zero tax. Sign me up.
That's a great deal.
I mean, Social Security, the way it works, as you mentioned, the provisional income formula, it's kind of like, the more pressure that gets pushed on it, the more it's taxed, right? Because of that provisional income formula. I mean, in my opinion, it's one of the best kept secrets when it comes to taxes. But let's talk about that pressure in terms of other buckets being pushed on Social Security. Does it get taxed? Tommy, let's do another example. Same 60,000, married couple, but they've got a different income for Social Security. They got to get to 60. Walk us through this.
Right. So in this example, the individuals have $40,000 of Social Security benefits and supplement with $20,000 from the IRA. They get to that 60. In this example, the income levels are low enough, they still pay zero taxes.
Both federal and state.
So when we talked about Roth conversions earlier, finding when taxes are on sale for you. The Roth can be that invisible bucket outside of there that's not showing up on the tax return. If we have an income need, we're taking enough out of the IRA to be tax smart, and supplementing with that non-qualified account or that Roth IRA.
Yeah, that's a good deal. Well, let's say we need some more income. Let's keep her going. So let's say now we need $90,000 of income coming in. Let's walk our viewers through that.
Yeah, and we've mentioned the difference between ordinary and qualified dividends out of that non-qualified account. So we're going back to $60,000 in Social Security benefits for this couple, $30,000 in qualified dividends. They get a tax preference on that. So they're getting the $90,000 of income, and they, again, owe zero federal taxes.
I mean, wait, there's more. Okay, let's keep going. This is good. Okay, now let's say, I mean, again, these are different tax buckets that we're talking about. Let's increase that income. Now we need $120,000 of income. To walk us through that one.
So in this example, we have the same couple have $60,000 in Social Security benefits. Maybe didn't do that tax planning, or are taking $60,000 from a traditional IRA.
Okay.
So in the prior example, none of that Social Security benefit was taxable. In this case, 60 and 60. They get to about 75% of that Social Security benefits taxable, and owe around $8,500 in federal taxes.
On $120,000.
Still pretty good.
That's still not a bad deal. It just shows you how Social Security planning can also be a huge a deal when it comes to tax planning overall, because of the tax preference you get with it. Again, because one of the things people also want to know is when do I take Social Security? That episode, we've already done that one, so make sure you all tune into that one. But again, it's all about how to become tax smart along the way. I mean, this is some good information that we've provided today.
Right, and tying it all together, you have Social Security and IRA distributions, or you have Social Security, non-qualified IRA, Roth, using that Roth, but just monitoring those tax brackets and finding when taxes are on sale for you.
That's exactly right. And folks, I mean, this is also, again, why we offer that 15-minute retirement review. I mean, whether it's about taxes, whether it's about retirement, your 401k, you name it. I mean, we are truly here to help you, because again, these are things that everybody should be looking at. I mean, in terms of not just investing, you need to be looking at planning overall, and tax planning really should be the core of the planning process.
Tax planning, tax savings are a real savings to a retiree, but it is a piece of that puzzle. You have your investments, you have your income, health insurance, estate planning. You have everything together. This is one piece of it, but a very important piece.
That's exactly right. It's not always what you make, but what you keep. Thanks again for listening, folks. I hope you learned something today. We are on every weekend helping you get retirement ready. We'll catch you next time right here on Retire Vivid.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Cameron McCarty and Tommy Breitbach are investment advisor representatives of Vivid Wealth Management, a SEC-registered investment advisor located in Des Moines, Iowa. Investment advisory services are offered through Vivid Wealth Management, LLC. Insurance products and services are offered through Vivid Tax and Wealth Advisors, and individually licensed and appointed agents. Tax planning and preparation services are offered through Vivid Tax Center, LLC. The preceding entities are affiliated. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Case studies and examples presented are hypothetical and used to demonstrate a concept. These studies do not represent actual clients or results. Similar or even positive results cannot be guaranteed. None of the entities above are affiliated or endorsed by the Social Security Administration or any government agency. Information expressed does not take into account your specific situation or objectives, and is not intended to provide investment, tax, or legal advice. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Investments involve risk, and unless otherwise stated, are not guaranteed.
Thanks for watching Retire Vivid. Want to see more? Like and subscribe to our channel to stay up to date with exclusive Vivid content. Plus, be sure to watch our show Retire Vivid every weekend. We're here to help you get retirement ready.